we now have a new moment in 2025, which is we now have more things becoming synthetic. And so that's why Bitcoin, of course, remains the OG in our view, because you now have a digital store of value. But I think you want to think about the other side of that ledger. What is Wall Street going to do? And in our view, Wall Street is going to play a very significant role in creating a market for digital assets. And in our view, the biggest winner here is Ethereum. So let's think about what it means for Bitcoin's upside. If gold today is at 4,000 per ounce, and maybe it'll get to 5,000 per ounce, well, we want to think about what Bitcoin's Bitcoin to gold ratio is. What percentage of Bitcoin's network value should mirror that of gold? And if it's only at 10%, then you get a $140,000 value for Bitcoin. I think that number is too low. I think it's going to basically match gold's value or even exceed it. And that's how you get to the $1.4 to $2.2 million of value per Bitcoin. So we're still quite bullish on Bitcoin here at around 110,000.
Tom Lee begins by putting Bitcoin's decade-long performance in perspective. When he first started writing about crypto 9 years ago, Bitcoin was trading at $963. Fast forward to late 2024, and it's returned over 100x, outperforming nearly every major asset class, even Nvidia, which has gained 65x in the same time frame. Gold, by comparison, has merely tripled. Ethereum, meanwhile, has outshined them all with a 500x return, firmly establishing itself as the second pillar of digital value.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
I've been writing about crypto for about 9 years now. And at that time, Bitcoin was originally $963. And as of September 26th, as you can see, Bitcoin has been the OG asset class, returning over a 100x since then. It's had twice the return of Nvidia, which has been a 65x, and has dramatically outperformed gold, which has roughly tripled in that same 9-year period. And as an aside, Ethereum has outperformed even Bitcoin, delivering a 500x in that period of time. Okay, so let me level set. The reason I think 2025 is the biggest macro shift since the gold standard is I got to take you back to 1971. And in 1971, the dollar went fully synthetic. That was the year that Nixon ended the convertibility of dollars into gold. Now think about that for a moment. In 1971, the dollar no longer represented anything except another dollar or a promise to repay. And when we think about that, most people said, well, gold was the trade in 1971. That's true, but it wasn't really the big opportunity. In 1971, the financial system had to suddenly think of ways to make sure the dollar remained dominant, because if the dollar wasn't convertible into gold, another currency could be dominant. And so what Wall Street did was they created a huge market for the dollar. Money market funds, futures, debit cards, mortgage-backed securities, currency swaps, interest rate swaps, index futures, zero coupon, CDOs, etc. That was the innovation that followed 1971. And in fact, 7 of the top 30 largest companies in the world now are financial institutions. Okay, well, another thing is happening today, which is that Wall Street and AI are building on the blockchain. And in the US, the groundwork was laid with the Genius Act, which set the stage for a stablecoin boom. And then the SEC launched Project Crypto, which is moving Wall Street onto the blockchain. And there, of course, are 2 other pieces of legislation underway in Washington. One is the Clarity Act, and the other is the Bitcoin Strategic Reserve Bill. And what that means is that we now have a new moment in 2025, which is we now have more things becoming synthetic. And so that's why Bitcoin, of course, remains the OG in our view, because you now have a digital store of value. But I think you want to think about the other side of that ledger. What is Wall Street going to do? And in our view, Wall Street is going to play a very significant role in creating a market for digital assets. And in our view, the biggest winner here is Ethereum. So let's think about what it means for Bitcoin's upside. If gold today is at 4,000 per ounce, and maybe it'll get to 5,000 per ounce, well, we want to think about what Bitcoin to gold ratio is. What percentage of Bitcoin's network value should mirror that of gold? And if it's only at 10%, then you get a $140,000 value for Bitcoin. I think that number is too low. I think it's going to basically match gold's value or even exceed it. And that's how you get to the $1.4 to $2.2 million of value per Bitcoin. So we're still quite bullish on Bitcoin here at around 110,000. But let's think about this other story arc that's going to develop, which is Wall Street is going to innovate on the blockchain over the next 10 to 15 years. Okay? And part of this story arc is, and we've already seen it, is that we're talking about stablecoins, which is tokenized dollars. So that's almost like the 1971 moment. But we're talking about tokenized equities, tokenizing credit, real estate, reputation, and eventually intellectual property. All things that are measured in the economy today. And I think there's going to be invisible measures that get monetized on the blockchain. Data collection, royalty payments, loyalty programs, agentic AI, and even important things like proof of human. So a lot will happen on crypto. And we already know Ethereum has experienced this ChatGPT moment because of stablecoins. Here's just a list of different companies and entities that are building stablecoin projects. And you might wonder, why does the US government care about stablecoins? Well, it's the same reason the US cared about the synthetic dollar staying strong. Today, the US dollar is 27% of GDP, but it's 57% of central bank reserves. That 57% shows you that Wall Street's efforts to make the dollar the standard of transactions after 1971 was effective. It's 88% of financial market trades, okay? But it's basically 100% of stablecoin denomination. So by moving to a synthetic dollar tokenized on a blockchain, the dollar could become even more dominant. And collectively, stablecoins are the 12th largest holder of treasuries in the world. By the way, that's at about 280 billion of stablecoin outstanding. Treasury Secretary Bessent thinks it could be a $4 trillion market, but once stablecoins own more than 1 trillion of treasuries, they will become the single largest holder of treasuries in the world. It's not that far away. And equally important, when companies build on the blockchain, they do essentially re-architect their business. They're able to actually become more efficient. And I think there's a lot of reasons for this. And by the way, as a side note, many of you wonder, how does AI fit into this idea of building on the blockchain? A16Z had a nice white paper. There's 11 sort of use cases for what you want to build on the blockchain around AI. I'm just going to highlight a few things, like number 3, forward compatible proof of personhood. That's like a project like WorldCoin. Number 6, keeping AI vibe coding apps in sync. I think an example of this is a device I'm wearing, which is Ucritter, and this is measuring the CO2 wherever you are. The ideal number is 420, and it's currently at 980. So there's a lot of rebreathing of air in this room. And they actually say you shouldn't make any important decisions when the CO2 is above 600.
Lee acknowledges the market's recent volatility. After a long streak of calm, 33 trading days without a single 1% move, the S&P finally saw a spike in activity, reminding investors that October is historically a volatile month. From 1989 to 2008, October produced some of the most dramatic one-day market swings, and this year is proving no different. But for Lee, this is not a sign of weakness. He sees it as a healthy reset, a reminder that even in bull markets, volatility is part of the natural rhythm. After a 36% rally in 6 weeks, he notes that optimism may be running a bit high, citing indicators like the put-to-call ratio and some lagging sectors such as regional banks and housing.
Okay, but you might, and we get asked all the time, what is the benefit of Wall Street building on the blockchain? They'll say that banks work fine. I don't see how JP Morgan can become more profitable. Well, actually, companies that are natively built on the blockchain are inherently more profitable. For instance, Tether is raising capital at a $500 billion valuation. Look at the list of the 12 largest banks in the world. Tether is the second largest. I mean, think about that. Tether is 50% bigger than Bank of America, and Bank of America is a giant. It's twice the size of Citigroup, twice the size of Morgan Stanley. It's even bigger than Goldman Sachs. Okay. But here's what's interesting. If you look at the number of employees at Tether, okay, JP Morgan is an $869 billion market cap company with 317,000 employees. That's a market value of $2.8 million per employee. Tether has 150 employees. That's less than JP Morgan's analyst class, you know? It's probably like the June analyst class. And so that means Tether has a market value of $3.3 billion per employee. I think that's what you have to realize. Tether, which is a native blockchain company using public chains, has a value nearly the size of JP Morgan and with only 150 employees. So as Exhibit A, in my opinion, clearly building companies and rebuilding Wall Street on the blockchain is very profitable.
You know, you think about it, Mike, we went 33 trading days in a row without a 1% move, either up or down. That was the longest streak since before COVID. So to say we were due is probably an understatement. You know, you look just at the last 2 days, yes, probably 2 days now of 1% moves. Just October 13th, little history for everybody. At 89, the S&P dropped like 6% on the UAL LBO deal that fell apart. And then in 2008, this day, October 13th, gained 11%. Mike, I'm not sure why, but there are more 1% moves in October than any other month. After I guess I'll say we've been spoiled with this rally, maybe some October spookiness and volatility is perfectly normal.
Certainly normal. I guess the question is, did it kind of break the market stride in any notable way? I mean, it's essentially, you know, once you've got the people who are in it because you can't get the market down, and this is a low volatility grind higher, and there's no real use in waiting for a dip to say, okay, maybe we're going to get a deeper pullback.
You're right. I love the discussion with Paul a little before I came on. He talked about some of the internals that are weakening. You know, I look at things like regional banks. Those are lagging big time. Housing's lagging big time. Look at high yield credit, right? That's starting to crack. So by no means are we saying there's this big monster under the bed. But Mike, there are some little things that have me concerned. And the last one, put to call ratios, you know, they're quite optimistic. And from that contrarian point of view, I just think it makes sense after a 36% rally in 6 weeks. Maybe we're due for just some, I guess, a Charlie Brown shirt type of volatility.
You know, you mentioned 35% up in 6 months, right? So I wondered if we were also suffering from a little bit of anniversary-itis in the sense of, wow, look at this massive 6-month move. Obviously also just hit the 3-year mark of the current bull market with some great gains, although maybe not, you know, I mean, kind of middle of the pack on the 3-year anniversary. But what can we expect from here as the bull market matures?
Yeah, we're still pretty optimistic, have been for a while. You know, you look at, there's been 5 other times we've gained more than 35% on the S&P in 6 months. 1 year later, higher every single time, up like 13% average. But I know some other guests have pointed this out. I'll just mention it. Once you get a bull market that gets to this point on its 3rd birthday, there's been 5 other ones back to 1950, all right? The shortest any of those other bull markets went was 5 years. The average, Mike, was 8 years. So listen, the reality is this is a strong bull market still, and to think it's just going to be over because we're here and it's 1929 or stocks are overvalued, we're not minimizing that, right? Earnings are still strong, profit margins strong, a dovish Fed. There are still reasons to think that this bull market's alive and well, and it might last longer than a lot of investors expect.
Yeah, I mean, now granted, that's what the math says, although it owes a lot to two very, very long bull markets, right? I mean, one that began in 87, the other one in 09. Fair enough. I guess the question is, where within the market, I mean, are you looking for some leadership transitions, large to small, away from growth to value, or stick with the winners?
We're sticking with who brought us to the dance, I guess we'd say. We still like industrial, still like cyclicals, financials. And we do like large over small. No smalls coming back today. We just think the Fed's probably not going to cut quite as much as what the market's expecting the next 15 months or so. I mean, there's still a lot of opportunity, right? When in doubt, diversify it out. There's been a great year to have a diversified portfolio. We're not changing that at all. We'd still just be overweight equities with a little bit specifically of developed international. We've liked that group for a while. Still don't think that one's over as well.
Yeah, that's right. So it has obviously been a global move as well. Quickly, Ryan, earnings growth for this quarter, probably not as underestimated as prior quarters.
It sure isn't. You know, you look at the pre-estimates, right? Actually, a positive pre-estimate on average. You haven't seen that since, like, I think late 2021. So a lot of good news is out there. So that's something. Maybe the bar is a little bit higher, but once again, I think earnings will probably come in better than expected. It's just how much better, because there is a little more optimism this earnings season than really the last several years.
Lee continues to favor the sectors that have driven the rally so far: industrials, cyclicals, financials, and large-cap equities. He's not chasing small caps just yet, noting that while they're showing signs of life, the Federal Reserve's path will be crucial to their sustainability. Overall, he remains overweight equities, advocating a diversified portfolio with selective exposure to developed international markets, which he believes remain undervalued. Earnings season, he adds, looks promising. Pre-estimates have turned positive for the first time since 2021, and while expectations are higher, Lee still anticipates upside surprises.